Welcome back to Accounting Made series, Accounting Made Easy series. This is Waidera Mwangi, and we are tackling accounting for assets. But today we want to move on and delve into a subtopic called depreciation. Normally, fixed assets or assets lose value through time. So what is depreciation? We are saying it is an accounting method used to allocate the cost of a tangible or a physical asset over its useful life. So we want to define some terms. What do we mean by useful life? We are saying this is the estimated time that the asset is expected to be productive to the firm and not necessarily how long it will last. What do we mean by cost? It includes the purchase price and any other expense incurred to get the asset ready for use. For example, we have installation fees, import duties, handling expenses, testing expenses, and professional fees, among others. What do you mean by a tangible asset? We are saying normally depreciation applies to physical assets expected to last for more than 1 year. And we are saying land is not depreciated since it has an unlimited useful life. They are also known as capital assets or fixed assets. So is depreciation important? We are saying depreciation is very important for the following reasons. One, reduction in tax. We are saying depreciation is a tax deductible expense. So this reduces the taxable income of a farm. Managing assets. We are saying depreciation helps farms to track the value of their assets and therefore plan for their future replacements. The matching principle. We are saying this principle holds that expenses incurred should be recognized in the same period as the revenues they helped to generate. Then the other importance is financial position. We are saying depreciation helps a farm to get a clearer view of its financial position. So we want to tackle this subtopic, tracking an asset through depreciation. So we want to look at some terms here, and we are saying depreciation spreads the cost of an asset for several financial periods, hence financial statements. For example, if an asset is worth $80,000 and it's expected to be productive for 8 years, then its cost is spread over those productive years. So accumulated, what do you mean by accumulated depreciation? We are saying this is the total amount of depreciation for an asset since it was acquired. We are saying for the above example, if the asset is depreciated by straight line method, depreciation per year would be $10,000. That is $80,000 divided by 8 years. By the end of the 5th year, accumulated depreciation will be $10,000 times 5 years, which is $50,000. So what do you mean by book value or carriage value? We are saying this is the estimated value of an asset after deducting the accumulated depreciation. For example, in the above example, the book value at the end of the 5th year is $30,000. How do we get that? We are saying it is $80,000. You subtract the accumulated depreciation for the 5 years, which is $50,000. Yeah, what do you mean by depreciable cost or this depreciable base? We are saying cost of an asset, that is the capitalized or recognized cost, less than the salvage value. The salvage value is also called the residual value. So you're saying the depreciable cost is the cost of an asset, you subtract the salvage value. So what is the depreciation rate? We are saying this is the annual rate at which an asset depreciates over its useful life. For example, we are saying in the above example, the rate is $10,000, which is the depreciation per year, divided by the depreciable rate, which is $80,000, is equals to 0.12, which is equals to 12.5%. So the asset is depreciating at 12.5% per year. So what do you mean by salvage value or the residue value? You're saying this is what the farm expects to receive after the asset is sold or scrapped or traded in after its useful life. In the above example, the assumption is that the scrap value is equals to 0. We are saying not all assets qualify for depreciation. For example, rod is an asset, but it is considered to have an unlimited useful life. So we want to look at methods of calculating depreciations. There are several methods of calculating depreciation. One of them is straight line or fixed rate method. We are saying in this example, the example that we have had above there, we are saying the straight line method of 12.5% was applied every year. So we calculated the depreciation for the first 3 years. We are going to say the first year depreciation will be $10,000, which is calculated as 12.5% times $80,000. Then the second year, we are saying this is it is a fixed rate method. So we are going to, the depreciation that we are going to get every year is constant. So for the first 3 years, the depreciation will be 10,000, 10,000, 10,000. So the next method is called the reducing balance or the declining balance method. We are saying using the above example and applying 12.5%, the depreciation rate will be equal to the first year it will be equal to 12.5% times $80,000, right, which we get $10,000. Then, because it is declining, the second year we shall have $80,000, which is the depreciable base, minus the depreciation for the first year, which is 10,000. So we get 70,000. So it has already declined. So we shall apply 12.5% to 70,000, where we get 8,750 as the depreciation for the second year. Then the third year, we are going to subtract the 8,750 from the 70,000. So it declines further. So we shall have 61,250 times 12.5%, and we shall get $76.56 for the third year. That is the depreciation. Then the other method that we normally use is the sum of the year digits. This method accelerates depreciation, but is calculated differently. For example, for a 5-year asset, add the years. So you're saying this is a 5-year asset. The asset will last for 5 years. So you're going to add the first year to the second year to the third year. So you add all those years and you're going to get a total of 15. So you're going to use fractions against the depreciable amount using the above example that you've already used. So the depreciable amount is 80,000 minus the salvage value, which is 80,000. So you're going to get 80,000 as the depreciable amount. So the highest fraction is used in the first year. So you shall have first year depreciation will be calculated as 5/15 times $80,000, where we get 26,667. Then the second year, you're going to get 21,333 because you're going to apply the percentage, the fraction as 4/15 times $80,000. The third year we shall have 3/15 times $80,000, where we get $16,000 as the depreciation. Then the fourth method is called units of production. We are saying the method accounts for usage rather than time. So you're going to use the above example, assuming it is a graphic printer that can print 1 million printouts in its entire useful life. So the depreciation will be computed as follows. So the depreciable amount is still the same. It is $80,000 minus the salvage value, which is 0, where we get the depreciable amount is $80,000. So the depreciation per unit will be equal to $80,000. We divide by the number of units that it can produce in its entire useful life, which is 1 million. And we are going to get per unit, the depreciation per unit will be equal to $0.08. So if it has printed 300,000 printouts since its acquisition, then the depreciation will be equal to 0.08 times the number of units, which is 300,000, and we get the depreciation up to that point will be equal to $24,000. So accounting for depreciation, we are saying the amount that will be depreciated will depend with the method that the firm decides to use. However, whichever the method that the firm adopts, treating in the journal and account is the same. So the journal entries are, you debit depreciation account with the amount that you have gotten as the depreciation. Then you credit the accumulated depreciation with the same amount. So you are saying the accumulated depreciation account is a contra asset account. At the end of the financial year, depreciation is transferred to the profit and loss account as an expense, where accumulated depreciation is used to show the book value of the asset. So a firm called JPL Enterprise has a machine that costs $200,000. The machine is estimated to be productive for the next 10 years, after which it will be sold for $5,000. Using straight line method, show journal entries and post the entries to the relevant accounts. Show the accumulated depreciation for the first 2 years of the machine's life. So the solution will be equal to, depreciation will be equal to 200,000 minus the salvage value, which is 5,000, and then you divide by the number of years, the useful years, which is 10 years. And then we get depreciation is equals to 19,500. So we are going to debit the depreciation account with 19,500 and the accumulated depreciation with a similar amount. And the narration will be, it is a depreciation charge. Then the next one will be equal to, we are going to debit profit and loss account at the end of the financial year with 19,500, and we transfer this and we credit the depreciation account to as 19,500, and we are closing the depreciation account to the profit and loss account, which we have shown in the accounts down there. So you have already debited, you have already debited the depreciation account and credited the accumulated depreciation account with a similar amount. And then when you are transferring closing the account, we credit the depreciation account, and then we debit the profit and loss account. So lastly, we are saying we have an assignment, show the balance sheet extract for year 1 and year 2. Thank you very much for being part of us. Thank you very much for subscribing. Thank you very much for being part of us. Thank you very much for continuing to support us. We shall meet in the next video. Thank you very much.